Buying a home should make your life better, not stressful. If your house payment takes up too much of your income, you may become house poor. A simple rule can help you avoid that. Try to keep your monthly housing costs, your mortgage, taxes, and insurance, at 28% or less of your gross monthly income. That means before taxes. Your total monthly debt, including your house, car loans, student loans, and credit cards, should stay under 36% of your income. This helps you keep money for savings, food, and everyday life. Another easy guideline: your home price should usually be no more than 3 to 5 times your yearly household income. Don't forget the hidden costs of owning a home. Plan to spend 1% to 3% of the home's price each year on repairs and maintenance. These costs are not part of your mortgage. A few things can change what you can afford. A bigger down payment lowers your monthly payment. Higher interest rates raise your payment. Other expenses like childcare, utilities, and debt reduce your budget. By staying close to the 28% rule, you give yourself room to breathe. You can enjoy your life, handle surprises, and protect your financial future. First things first, let's talk about your income. Your income is the most important number when you figure how much house you can afford. Everything else builds on this foundation. There is a very simple rule of thumb to get a quick idea of a good price range. This is not a hard and fast rule, but it is a great starting point. The rule is this: you can typically afford a home that costs between 3 times and 5 times your annual household income. Let's say you and your spouse have a combined household income of $60,000 per year before taxes. Multiply that number by 3 to get $180,000. Then multiply it by 5 to get $300,000. A good starting point is houses in the range of $180,000 to $300,000. This gives you a ballpark idea of what is realistic for your family. It helps you avoid wasting time on homes that are way out of your league. Should you aim for the top or the bottom? That depends on your goals and comfort level. If you have other debt, like student loans or car payments, stay on the lower end. If you have no other debt and a big down payment saved up, you can lean higher. This rule keeps housing from taking over your budget. Buy 10 times your income and you'll struggle monthly. A house is meant to be a place of peace, not constant financial stress. Use the 3 to 5 times rule as your first step toward a wise decision. Next, we need to talk about debt. Debt is the biggest obstacle between you and your goals. It steals your income and robs your future. Lenders look at your debt-to-income ratio, or DTI. It shows how much of your monthly income goes toward debts. It's critical. Know yours. First, add up monthly debt payments: car, student loans, credit cards, any loans. Do not include current rent or utilities. Say your total monthly debt is $800. Next, find your gross monthly income, before taxes. $72,000 a year is $6,000 a month. Now divide debts by income. The result is about 13%. That's your DTI before a house payment. Lenders generally want total DTI, including housing, around 36 to 42%. For breathing room, aim to keep your total housing payment, mortgage, taxes, insurance, at 25% or less of your take-home pay. Every dollar to a car or card bill is a dollar you can't use for housing. Get out of debt before buying. Pay off the car, student loans, and credit cards to free up hundreds each month. You'll afford a better home and build wealth faster. Do not let debt kill your dream of homeownership. All right, let's talk about saving money. Saving is your superpower when it comes to buying a home. The most important thing to save for is your down payment. It's the portion you pay upfront in cash. The rest is covered by a mortgage. The gold standard is 20% down. On a $300,000 home, that's $60,000. Less than 20% often requires PMI, an extra fee that protects the lender, not you. PMI can cost hundreds monthly. Money wasted. Saving 20% can take time and sacrifice, but it's worth it. You'll have a lower payment, avoid PMI, and start with more equity. If waiting isn't an option, FHA loans allow smaller down payments, sometimes as low as 3.5%. Be aware, they can have higher long-term costs. When you think about the cost of a home, the mortgage payment is just the start. It's the biggest piece, but not the whole picture. Include property taxes, homeowners insurance, HOA fees, maintenance, and utilities. Property taxes fund local services and can add hundreds monthly, often escrowed by your lender. Homeowners insurance is required with a mortgage and typically escrowed too. Think PITI, principal, interest, taxes, and insurance. HOAs may add from a little to several hundred a month. Maintenance happens. Set aside at least 0.5% of your home's value yearly, about $1,500 per year, or $125 a month on a $300,000 home. When you add it up, the real cost is much higher than just the mortgage. Now, interest rates. A small number with a massive impact. On a 30-year, $400,000 loan at 3%, your payment is about $1,686. At 8%, it jumps to about $2,935, a difference of over $1,200 per month. That's money for other goals. When rates are low, borrowing power rises. When rates are high, it shrinks. A strong credit score, larger down payment, and low DTI help you qualify for a lower rate. Shop multiple lenders. Even a quarter point matters over 30 years. Never accept the first offer. Negotiate. Getting the best rate is one of the smartest moves you can make when buying a home. Okay, we have covered a lot of ground. We have talked about income rules, debt ratios, down payments, and hidden costs. Let's put it together with Sarah and Tom. Their combined annual income is $70,000. 3 to 5 times income gives a range of $210,000 to $350,000. They target the middle, around $280,000. Monthly debts total $600. With a conservative 36% cap, total debt payments should be about $2,100. Subtract other debts, leaving about $1,500 for housing. On a $280,000 home, 20% down is $56,000. Mortgage is $224,000. At 5%, principal and interest are about $1,200. Add roughly $300 for taxes and insurance. Pity fits at $1,500. It fits their budget without stress. Buying a home is a journey, not a sprint. First, use the 3 to 5 times income rule. Set a realistic price range. Second, calculate your debt-to-income ratio. Be honest about all debts. Aim at or below 36%. If it's too high, pay debt down first. Third, save a big down payment, 20% to avoid PMI, and keep a 3 to 6 month emergency fund. Next, check credit, clean errors, raise your score. Get pre-approved and shop 3 to 4 lenders for the best rate. Build a detailed monthly budget including every cost. How much house can you afford without becoming house poor? Most people buy a home based on what a lender approves, and that's a mistake. To stay financially safe, be patient, stick to your budget. Be willing to walk away, keep your monthly housing costs under 28% of your income and all your debt under 36%. A simple rule of thumb, your home price should be no more than 3 to 5 times your yearly income. Follow this, and you can own a home and still enjoy your life. Please don't forget to like, share, and subscribe.